By the time Daniel retires, one account he opened in his 20s will be worth more than $700,000 more than the same account would be if he'd waited just 10 years. Drake made that opposite choice. He never even noticed he'd made it. I have a 401k. Isn't that the retirement thing? It's one retirement thing. There's a second account almost nobody's employer mentions, nobody auto-enrolls you into, and it can end up worth as much as everything else combined if you actually open it. Today, what actually happens if you never open a Roth IRA, what 10 years of delay really costs, and exactly how to fix it starting today, whatever your age. All growth figures ahead are illustrative, using a historical average return, not a promise of future performance. A Roth IRA is an individual retirement account you open yourself, not through your employer, funded with money you've already paid income tax on. In exchange, every dollar of growth inside it and every qualifying withdrawal in retirement is completely tax-free. Forever, Daniel opened his at 25. At an outside brokerage, Fidelity, Schwab, and Vanguard are the three most common places people do this, and set up an automatic monthly transfer into it, the same way he treats his 401k. That's the mechanics. What actually matters is what happens if you skip it. Drake isn't behind because he's careless. He's behind because nobody specifically told him to open a second account. His employer auto-enrolled him in a 401k on his first day. Nobody auto-enrolls anyone into a Roth IRA. You have to find it yourself, at an outside brokerage, with no HR department reminding you. The second reason is timing. A Roth IRA doesn't feel urgent in your 20s. There's no employer match pushing you to act, no deadline this month, just a quiet, correct decision that's easy to push to next year. Drake pushed it every year for a decade. Not one bad decision, 10 small ones that each felt like no decision at all. Here's the actual math, using the 2026 contribution limit and a 7% average annual return. A commonly cited long-term historical stock market average, not a promise of future performance. If Daniel contributes $7,500 a year starting at 25, every year until 65, 40 years, that account grows to roughly $1.5 million. If Drake makes the exact same contribution at the exact same return, but starts at 35 instead of 25, just 10 years later, his account reaches roughly $708,000 by 65. Same yearly amount, same return. 10 years later start. The gap is close to $790,000, more than half the total gone because of 10 years of delay, not 10 years of smaller contributions. That's the part most people underestimate. Drake didn't contribute less money over his lifetime. The money he didn't contribute in his 20s never got the extra decade to compound that Daniel's did. Time in the account, not the size of any single contribution, is doing most of the work. Now stretch that to the actual question in this video's title. What if you never open one at all? It's not that Drake ends up broke. His 401k and Social Security still exist, but he permanently loses one specific advantage no other common account gives him: a pool of money that isn't taxed again on the way out and isn't touched by forced withdrawals. A traditional 401k or IRA forces you to start withdrawing starting at age 73, whether you need the money or not. And every withdrawal is taxed as regular income. A Roth IRA has no such requirement ever for the original owner. It can sit and keep growing tax-free for as long as you're alive. Skipping it doesn't just cost growth, it removes flexibility Daniel will still have decades from now. If money is limited and you can't max both accounts, the order you fund them in matters. Step 1. If your employer offers any 401k match, contribute enough to get the full match first. That's an immediate, guaranteed return no investment can beat. Turning it down is leaving part of your paycheck on the table. Step 2. Once you have the full match, direct additional savings to the Roth IRA up to its limit. It's smaller than most 401k limits, so it's realistic to max it in a way a full 401k often isn't. Step 3. If there's still money left after that, go back to the 401k and keep contributing above the match, up to its own annual limit. Drake's mistake wasn't contributing to his 401k, it was stopping there. Every dollar he put in past the match went into an account that will be taxed on withdrawal, when a smaller, equally available account sitting right next to it would never be taxed again. There's a second, quieter mistake that costs people almost as much as never opening the account at all: opening it, depositing money, and never actually investing it. A Roth IRA is just a tax wrapper. On its own, the cash inside it doesn't grow the way the market does. It sits close to flat, the same way any uninvested cash would. Every one of the growth numbers in this video assumes that money is actually placed into an investment, commonly a broad, low-cost index fund, inside the account. Depositing money and never selecting an investment is one of the most common and expensive mistakes new Roth IRA owners make, and it's usually just one drop-down menu away from being fixed. If you're past 25 watching this and feeling behind, the math still works strongly in your favor starting today, just at a smaller scale. Opening a Roth IRA at 45 and contributing the max every year until 65, 20 years at that same 7% average still grows to roughly $307,000. Starting at 55, just 10 years, still grows to about $108,000. Neither of those is the $1.5 million from starting at 25. Both are enormously better than the $0 from never starting at all. And if you're 50 or older, the 2026 rules let you contribute more specifically to catch up: $8,600 a year instead of $7,500, an extra $1,100 built into the law to help late starters close the gap faster. 3 rules to actually act on this year. First, the contribution limit. For 2026, you can contribute $7,500 if you're under 50, $8,600 if you're 50 or older. Second, income limits. Roth IRA eligibility phases out at higher incomes. For 2026, single filers lose the ability to contribute the full amount once modified adjusted gross income passes roughly $153,000, and can't contribute at all above about $168,000. Married couples filing jointly phase out between roughly $242,000 and $252,000. If you're above those limits, there's still a legal path in, commonly called a backdoor Roth conversion, contributing to a traditional IRA first, then converting it. It has its own rules and potential tax consequences depending on other traditional IRA balances you already hold, so it's worth researching specifically or talking to a tax professional before using it. Third, the deadline. Unlike a 401k, which closes on December 31st, you have until tax day of the following year to make a given year's Roth IRA contribution. Your 2026 contribution can be made as late as April of 2027. A Roth IRA isn't complicated. It's an account you open yourself, fund with after-tax dollars, and never pay tax on again. 10 years of delay can cost you more than half the final balance. Never opening one at all costs you the one pool of money that's never taxed again and never forces a withdrawal. Get your employer match first, then max the Roth IRA, then go back to the 401k, and once it's open, actually invest the money inside it. Don't just leave it as cash. Starting late is still dramatically better than not starting. If you don't have one open by the time this video ends, that's the one thing worth doing today, not next year. This video is for educational purposes only and is not personalized financial advice. All growth figures shown use a 7% average annual historical return as an illustrative example. Actual returns vary and are never guaranteed. Verify current contribution limits, income limits, and backdoor Roth rules at irs.gov before making any contribution. If this made 10 years of delay feel real, subscribe. New videos every week on the personal finance topics school never covered. Next up, what happens if you took every tax refund you ever got and invested it instead of spending it for 10 years?